Hey folks, thanks so much for coming tonight. As I said before, I'm Betsy Heller, Achievers Realty. We've got Brian Crumbaker here. Please forgive me. Brian Crumbaker here from Brightway Insurance, and he and I are going to talk through the things that he and I talked about last week, because I was so impressed with all of the information that he had that I just felt like it was so important to get it out to you guys and make sure that you understood some of the information that he had. I'm sure we won't do much more than scratch the surface, but I'm sure it'll help you. So maybe we can start with what are you seeing right now when it comes to insurance in any given zip code that maybe only part of the zip code is high fire?
Sure, yeah. So you and I talked about this before, but I think it's probably best just to start with how did we get here?
Yeah.
So in California, there's Prop 103, which is the insurance regulation that kind of drives everything that happens in insurance, whether it's auto, home, or any other line of business. It was created by an individual who continues to actually profit quite a bit from it. So it's an interesting dynamic that occurs. But within the context of that regulation, carriers, if they want to take a rate increase of more than 6.9%, they have to go to a public hearing, and then they have what are called these public interveners, which is one of the creators of the statute. That's what he does. He's a public intervener. So what's happened over time is, because carriers didn't want to deal with all the hoopla of a rate hearing, they would file for a 6.9% rate increase and then immediately file it for again and again and again. So that's kind of how things would happen in California. So the theory behind Prop 103 was, we're going to suppress rates, we're going to keep them down. And if you were to look over a long period of time, that may be true, that rate increases may have been less, but they were never, I don't know, does anyone remember a decrease in California? They don't really exist. And part of the reason for that is, carriers are so afraid they would never be able to get a rate increase, they refuse to take rates down even if things were good. So that's a little bit of kind of what's happening just regulatory wise. Now, it's become somewhat outdated. I'm only going to talk about property, but auto's just as bad. So that's for a whole nother day. But on property, there's a couple of things that are really important that carriers have really struggled with. So pre-COVID, with all the big fires that came in, a lot of carriers lost quite a bit of money. Now, keeping in mind they can only get a certain amount in rate increase, they started immediately trying to file the rate increases to recoup the billions in losses. And then COVID hit, and the commissioner's position on that was, we're really not going to freeze rate increases. So it really kind of, when you put that thumb on the scale, it really disrupts the market. So you had a lot of carriers already concerned that they were losing money, not able to recoup some of the losses. And then, compounding that, two things in the statute that even the commissioner now will tell you need to be modernized. One is, carriers right now are not allowed to rate for what their expected catastrophe losses are. So they have a pretty good idea probably where fires are going to happen and what losses might look like, but they're not allowed to prospectively rate for that. That's a smaller issue of the two. The more important issue has to do with the cost of reinsurance. And in order for a healthy market in any state, especially California, carriers need access to reinsurance in order for them to grow and be able to offer insurance to you. So what is it? Reinsurance is insurance for insurance companies. So when you think about the regulators want to make sure that any insurance company that writes insurance in the state has enough money set aside to pay claims if it actually happens. So for every dollar of risk they take on, you got to have 50 cents in the bank. So if you're paying $1,000 in premium, they got to set aside $500 for losses. Now, if you have a $100,000 loss, there's a whole bunch of other people that they set aside money to pay that, right? But the way that carriers can expand that, because if it's 2 to 1, so it's $1 for 50 cents, even State Farm has to go and say, look, I can't take on any more without some help. I don't have 50 cents for every dollar. The way you get that is by buying reinsurance. So reinsurance companies, they lend their capital and they also share in the losses when they actually happen. Well, historically, that cost of reinsurance has been very manageable. It's been maybe a few pennies in your premium. Of your every dollar in premium, you pay me a few pennies. In the last 4 or 5 years, it's probably like 20 cents now. So the department has said, carriers, you cannot pass through the cost of reinsurance. So what's resulted is carriers now seeing and saying, I can't even make money here anymore. I am guaranteed to lose, on the next dollar premium I sell, I am guaranteed to lose money because I can't pass through 20 cents of the dollar that I have to account for. So that has created a whole host of problems in the market. So it starts with wildfire. And so where historically maybe your house is located, they actually really looked at just the true fire risk. And now you overlay that with really troubled regulations and insurance commissioner that has been in many ways inactive. And now you have carriers saying, I can't make money, so I'm going to blame wildfire on everything. So now you could live, in the middle of a concrete field and you're going to get told it's wildfire. So that's why I said before, we all live in a wildfire area now, because carriers are struggling even to make money. State Farm so much so that their most recent filing, because they have a separate company in California, they said if we don't get the 40+% rate increase we're asking for, we're going to claim insolvency and move along. That's how serious it is.
40%.
So there's a lot of
crazy, right?
there's a lot of rate increases that are going to come through because of all this pent up stuff that's happening. So because there's this big profitability concern, I've never seen a market like this, where almost every carrier now has said because we know we're losing money, we just don't want to write business. So it's irrational. So you're either getting non-renewal notices or they don't want to take new clients.
So can you talk about what they're required, like on a federal level, how much reserves they're required?
Yeah, it's generally 2 to 1, right? So for every dollar premium, they have to have 50 cents set aside.
So contrast that with the banks on a credit card. So for every $1,000 of credit you're extended in a bank, the bank only has to keep $100 in the bank. So it's 10%. But for insurance companies, it's 50%. That's a lot of money. And then how much did you say State Farm had in claims last year?
Well, they probably lost over $1 billion in California alone.
But did you say something
But they lost, so on a countrywide basis, State Farm lost $16 billion last year. It's an extraordinary sum of money. And they lost more money than most companies are in size. So it's a pretty extraordinary event, and it's a lot of things. So California has its unique issues with wildfire. Texas has wind and hail and water. The Midwest has all these convective storms, and so it's not one, it's 40 of these small storms that are all adding up. So we used to say we want to be a non-cat prone area. Well, they don't exist anymore. There's catastrophes everywhere all across the United States. So it's an interesting time to be in insurance and to figure out how to price it. So we have a real issue in California, but it's just as bad in Texas, and Colorado, Arizona, Florida. It's really a countrywide issue. So
before we go on to the things that they can do, and we'll take questions, I promise, at the end. But before we get to that, tell them about what you were saying about outdated laws and what they could do if they want to participate using, the almighty pen and paper.
Yeah, so right now, like I said, because the laws themselves are outdated, and this is in some ways I call it a man-made issue. I mean, the commissioner really just, I would say if he were here, it hasn't done a very good job with managing us through the big issues. We as consumers need to demand action with Sacramento and with the insurance commissioner to say enough is enough. Insurance has become unaffordable, which means not only is it costing me more money to live in my home, it's harder for me to sell it because the next buyer is having a really hard time finding insurance. So it's much bigger than just even whether you can insure your home or not. It's the ability to buy and sell property all throughout the state of California. So as consumers, we need to be more active. We need to start screaming at Sacramento to say, hey, you need to fix this. Get off your hands, let's start moving, because it just seems like until it becomes an uber crisis, and I'd say we're there. I mean, you can Google California home insurance crisis and you'll get a bunch of articles. Even the commissioner has said it is a crisis. And so we've got to deal with it. Newsom put out an executive order saying it's a crisis. So it's a big deal, but we still need him to move. And I think the more that you can make your voices heard, the better it's going to be. Because right now it's kind of like off in the corner somewhere. And so they'll deal with something else versus what this is such a big part. I mean, our homes are probably, for most of us, our largest asset.
So this is like at state assembly level and state senate. Those are so either side of that, you're just looking to actually. I heard this statistic a long time ago in doing some helping my parents on grassroots campaigning. One letter is worth 10,000 votes. One letter. So when you actually sit down and write a letter and say, I want you to legislate what needs to happen to move this forward. I want you to raise the ceiling on this so that so we have more insurance available to us. That is worth 10,000 votes then, because there's 9,999 people who won't write the letter that you are still representing, and they know that. So I just wanted to really encourage you on that we're going to have we're going to go ahead and put up some sample letters and stuff after this on our webpage. So if you don't want to think about it creatively, we'll just have some up there, and you can grab it and change a word or two so that they don't think it was just spammed out, and send it, because it's really important. It doesn't matter what your political background is. This is just affecting everybody. We want them to help individuals and get this done.
Yeah, we don't have a healthy competitive market. So I can tell you, within our agency, we represent all the big brands other than State Farm and Farmers, because they're captives. But Travelers, Nationwide, Safeco, Mercury, Allstate have all come into our office and said, we're trying to shrink so you can sell one policy a month. That's how bad it is. So when people come in and say, I want to buy insurance, it's not just whether you're in a fire area or not, it's so much bigger than that now. So it is worth your time to send that letter in, because the competition is leaving. It's not coming. So it's less and less. And so the weird things that have come out of it. So again, location is one piece, but because carriers really are trying to de-risk or get off of risk in California, they're getting a lot more aggressive on things you've never heard of before. So condition of roof. If it's an older roof, companies will either non-renew you or won't take you. Your plumbing. If your home was built in the 70s and 80s, they're looking to see that your plumbing is actually in good working order. If it's not, they'll non-renew you or they won't take you. HVAC, if you got old furnaces, you got to replace them, and electrical. This has actually become a really big issue within our office in the last couple of years. But Challenger and Zinsco panels are highly dangerous, and insurance companies will not take them. So SDG&E may have grandfathered them in, but insurance companies have said, we're not interested. And so when you sell the home, if you've got a Zinsco panel or a Challenger panel, your buyer won't be able to get insurance.
So to that end, and Brock's probably the only one, although no, Evelyn probably can speak to it too, and Jon can for sure, how many times I've been in a transaction on the buyer's side, and it's a Challenger or a Zinsco panel, and I'm writing in the bid for the cost for replacing the panel, because we know it's a fire hazard. My home inspector's already written it up that way, so it's got.
Yeah, and the challenge with it is, so if you're thinking about selling your home, get started, because SDG&E takes forever. It could take them 3 months before they'll even give you the permit. You can't do anything without that SDG&E permit. Once that's done, then the electrician's usually pretty fast, but we're running into that where it's taking 3 and 4 and 5 months even to get SDG&E to allow the change, which is crazy when you consider it's a fire hazard. You'd think SDG&E be all over it, but they're not. So
you need a permit to swap out electrical panel?
Yes.
Yeah. Yep.
Which I'm sure they'll be looking for.
It's at least a 4-month wait. We just finished calling for one of the properties that we manage, and we can tell you for sure it's at least 4 months, and you cannot get them on the phone without a very long wait.
Yeah, I mean, think about it too, because when you replace a panel, SDG&E has to be involved. They can't not be, so they have all the leverage.
So there you have it. So can you speak just a little bit about what you said about how insurance companies don't just even look at a zip code, I was talking to you about, there's a client who can't attend tonight, which is one of the reasons why I'm videoing, and they live in Rancho Penasquitos, but they're not close to Fire Mountain, and they do have an area below them that's actually got homes backed up to it, so everything's cleared. There's nothing not cleared, but she was still dropped from insurance.
Yeah,
She's
so-
still stuck on the fair plan.
Yeah, so think about, again, setting dollars aside, right? So carriers talk about that in terms of what they call their capacity. So they'll say, look, I have this much in revenue, I have this much that I can set aside for new policies. That's my capacity, and once I reach that, I can't take on one more home because I don't have enough money in the bank to support that. So certain zip codes are going to start filling up. So even if you're not on a canyon, but you're in 92003, I'm in Bonsall. So if I could get insurance today, that's it. The carrier's out of capacity. A neighbor across the street calls and he goes, sorry, wildfire. And it's a function of how much capacity every carrier has. And again, because carriers are now trying to shrink and reinsurance is too expensive and they can't get it, capacity is really starting to come down. So you're starting to feel that pinch much more than you would have historically. And then outside of capacity, what's less obvious to folks is wind patterns. So the carriers have got really sophisticated models because we've had enough fire activity now to kind of know the impact of wind. So when Camp Fire happened, I forget the name of the community, it's about 50 miles south. They had horrible smoke damage, and it was as bad from a total loss perspective as the Camp Fire itself. So that's not always obvious for some folks too. You may be going, I'm looking around, where's the problem? Well, you may be downwind from something that actually is higher risk.
That makes a lot of sense.
Yeah.
Right. The secondary impacts. So is there what about any other secondary carriers? I know I talked to you about, I'm going to say what I've seen over the last, 8-9 years. I was telling you that I've seen renters who get these $5 rental insurance policies from Lemonade, and I used to, tell the tenants, get it at your own risk. Who knows if they're going to be able to produce, right? Well, now Lemonade's like an A- company. Like they've really built their wealth so much. How about some of these other smaller carriers that are now coming up because of this?
Yeah, so our market's a little interesting because so many carriers are fleeing. We're going to see some newer ones that come in as well. So there's two rating agencies. One's AM Best. AM Best has been around forever. Everyone knows and understands AM Best. Demotech is the other one, not as favored. Some companies will go Demotech because it's easier. But if we just talk about in terms of AM Best, any carrier that's A- or better is fine. So A- to A to A+, and A++ is just the size, but claims paying ability is fine. So you'll see a lot, like Mercury's a perfect example. They're an A- carrier. They were founded in California. They've been here since the 1940s. They're fine, good company. Travelers is an A++ because they're the largest publicly traded insurance company in the United States. They're huge. Both very good companies. Travelers is just a lot bigger, but they're all safe. When you start getting into B-rated carriers, that's a whole nother story. So I would avoid them. Your lenders won't allow you to have them. So you'll have to be, you have to be with A- carriers. Now, because in the state we're losing so many of what are called admitted companies. These are all the brands you've heard of. They have to get licensed and get approval before they can do anything. Because they're leaving, there's a secondary market that's called non-admitted carriers, and they're just fine. It's just they don't have to file their rates and their rules, so they can compete and charge what they need to charge to be successful. And thank God we have it. Even the commissioner said we need this market right now. So that group is what's becoming a lot more influential in what we're seeing, because they're the only ones willing to actually compete. But they're competing in what I'll call the middle market, where home values are under $2 million. The over $2 million market, there's like two companies, that's it. And so we're seeing premiums of $50,000 for houses that are in that higher value market. So what we tell clients is if you have insurance and you're one of these higher value homes, keep it. Don't change, because what's out there is not so good. Now, if you don't have an admitted option, you don't have a non-admitted option, then the fair plan is your last option. We try to avoid it. They're the insurer of last resort for a reason. It's just a fire policy and nothing else. You actually have to buy two policies when you're with the fair plan. So it doesn't work well with high value homes because the total coverage you can get is $3 million. And that's for the home, loss of use, personal property, etc. So again, it works in that middle market tier.
have the FAIR plan or anybody knows someone who has the FAIR plan, pretty much everyone knows somebody that has it, right?
Yeah, so the FAIR plan is what I would describe as a quasi-governmental entity. It's actually supported by the insurance companies, but it's kind of managed by an independent group, and the DOI kind of has their hand on it. But it is substantially underfunded. They kind of do whatever they want. However, they basically have a bottomless pocket, because if they don't have enough money, what they'll do is just surcharge every active carrier in the state and you and I. So if they run out of money, they'll just pull it out of our pockets. So it will pay its claims, but it's going to come at a real cost. So right now we're kind of in a bit of a danger zone. I mean, the FAIR plan's probably grown, I don't know, 10x in the last 3 years, and its reserves are nowhere near where they need to be if we were to have a massive fire somewhere. But yes, that's how it funds itself. It funds itself through assessments of the participating insurance companies in the state, which, by the way, is based on market share. So when State Farm says, I want to shrink, part of the reason is they don't want to pick up the bill that FAIR Plan puts out a pretty massive assessment.
So back to why I'm saying one of our best things to do is put pen to paper, because the FAIR plan puts all of us at risk, not just the people who actually have that plan. Although the people that have that plan, it puts them even more at risk. So here's where we are, right? And just to reiterate, what are some of the things that they can do? So proactive things, steps that they can take.
So on the wildfire side, hold yourself and your neighbors accountable to the basic defensible space guidelines. You can go to CAL FIRE and you can see it. It's kind of interesting. Every municipality has these guidelines. They're supposed to be holding us accountable and fining us if we don't, but they don't. But what you need at least 5 feet of space around your house. You don't want brush touching any wood fences, overhanging your roof, or touching your home. Your insurance companies are holding people to account now. So you're going to start seeing neighbors going, I had to cut everything back. It's coming. So if it hasn't happened yet, it will happen. Yeah.
My area, they do grants, the defensible space grants, so I'm not sure how that applies to everybody else, but they give us about $2,500 roughly a year to start working on that, and then an inspector will come out and make sure the work is done. So
She's in the county.
yeah.
You're in the
so
county.
take advantage of that for sure.
It's if you're outside the city limits of whatever, so you might be in a city zip code, but if you're in the unincorporated area of that zip code, then you're eligible for those grants, which is at least another way.
Take advantage of it.
To get tree trims and the bushes, and I mean you can do it yourself too, and then you just log it, and then they'll reimburse you.
They will also pay for some basic landscaping, so you can actually apply for a grant for putting in drought-tolerant landscaping that's also fire resistant.
Yeah. So it's all good. Carriers are a little behind. You're not going to get credit for that right away, but I would be proactive with it because it's coming, and it's frankly good hygiene. I think no one wants their house to burn anyway, so it's better just to do that. So from a wildfire perspective, that's definitely will be helpful. Absolutely make your voice heard and have everyone you talk to say you need to write your local representative, go in their office, make them know that this is an important issue, so that when they go back up to Sacramento, they're going, man, I'm hearing a lot about this, because that's the only way we're going to make the real change. Because we need a healthy, competitive market, and we don't have it right now, and that's going to be the thing that's going to be most impactful. And then the last piece is going to be around, because carriers are trying to shrink, they're looking for other ways to do so, and so those are those 4 main things I was talking about. Make sure you stay on top of your roof. If it's a shingle roof over 15 years old, you're going to have to replace it because the carrier is going to make you do it. Tile roofs over 25 years. The other thing we're seeing is a lot of carriers are doing aerial photos now, and they're saying there's mold, mildew, and algae on your roof. Clean your roof. So if you have a tile roof and it's got dirt, moss, whatever, clean it off, because that will get you over that hump. Same thing, furnaces. Replace old furnaces. Older electrical, make sure that your breaker box is up to code. Have someone come out to make sure you're good. And then on plumbing, if it's old plumbing, if you have a 70s house and it's old plumbing, make sure someone comes out and takes a look at it. But if you've had a water claim, like a burst pipe on an older house, you're gonna end up having to repipe, because most carriers now, once that one water loss happens, they'll either non-renew you or they won't take you as a new client. So those are the main things to be thinking about, especially if you're thinking about buying or selling. Know what's going on with those 4 main systems, because that's where your insurance carriers are gonna give you the hardest time.
Oh, so many questions. Let's start with one related to what you're talking about. You said with the FAIR plan, you didn't quite talk about what that covers, but you need another policy to cover everything else because it's only fire.
That's right.
So could you talk a little bit about those other policies?
Sure. So if you have to go to the FAIR plan, think of the FAIR plan as fire only. That's it. Nothing else. You have to get what's called a difference in conditions policy or a wraparound policy. It hugs the fire policy. And that covers wind, water, theft, and liability. So it's everything but fire. So that's how we talk about it with our clients. Fire only, everything but fire. You need both policies to do it. The everything but fire policy, that DIC or difference in conditions, is usually pretty cheap. It's going to be $1,500 to $2,000. The fire policy, depending on where you are, is where all your expense is. But oftentimes clients will say, well, I'll take the cheaper one. I'm like, I know you would, but unfortunately it doesn't cover the fire part. So you do need both. So like I said, FAIR plan's very limited, and then it just covers the fire loss.
Well, I do have one property in Kern County. It's not exactly in a fire area, and it's not worth very much. It doesn't rent for very much. It doesn't rent for enough to pay for any kind of fire insurance, much less anything else.
Yep.
So, can I get the wraparound policy that covers everything but fire, and be
Yeah,
done-
so
be
generally
done with it?
carriers they don't allow you to do that. They want proof that there is a companion policy, a fire policy with it. Any agent worth their salt wouldn't do that because there's a huge errors and omission exposure for me. I can't knowingly sell someone basically half a policy. And so you really need to do both. So I have seen in some instances where people will try to just do the fire only, but again, now you don't have any liability coverage. It's the better way to mitigate that is to carry higher deductibles versus going bare on the property.
But if you can't get fire insurance at all in some of these areas.
So the FAIR plan will sell you fire insurance. So you'll get it. I mean, that is why they're the insurer of last resort. You will be able to get it.
But it'll be very expensive.
Yeah, I mean, what you're describing doesn't sound like it'll be very expensive. If it's a lower value and you had a higher deductible, I don't know that it would be that expensive.
And even if you didn't have a mortgage that was forcing you to get
Right.
both policies, most leases that you're going to write with a tenant talk about you having the structure policy, and they have a contents policy of insurance. So if you don't have a structure policy and the house burns down, they can then sue you. You're kind of stuck if you're renting it out. If it burns down in your own family, that's one thing. But if you have it rented out and you have something like that written into, certainly standard in all the California Association of Realtors leases.
Yeah, I'm trying to amend it, but.
It just leaves you
So
open
you
to
say
liability.
you really can't buy just everything else?
I'm prohibited from, my carriers won't allow me to do that. So the carriers that I write with that offer difference in conditions require that the client also show proof of a companion fire policy.
Okay.
For the because here's what happens. Fire comes in, burns the house down, and the client goes, I had no idea fire wasn't covered. You told me it was covered. And so the carriers have said, we're not playing that game, so either you show you have fire coverage or we're not going to cover it at all. Not to say you would do that, but people have been known to do that. So.
Good question. Any other questions? Go for it.
Got about 10 of them. So, Franny and Freddie, the new guidance that's out on roof RCV, are they really going through that, or have they put that on hold?
I didn't know that, but John might know that. John?
I didn't hear the question.
Freddie and Fannie have come out with new guidance saying that in order to get a loan, and they control 70% of the market, that you have to have full RCV on the roof, and it's a product that's not offered if your roof is more than 10 years old. We just had a place called the restaurant.
Yep, I'm seeing that happen more often now. Yep, I've had a few loan officers call me and say, "What's going on? My client, the condo association only has an ACV roof." I said, "The condo association needs to replace the roof. Then you get RCV." So that'll be the issue that you run into. Condos is where that's going to be the problem most often, because the roofs are old. And so as long as the association stays on top of it and that roof is new, you'll have no problem getting
But it has to be
RCV.
10 years old.
Yeah, I'm not aware of the 10-year-old rule. I know most insurance companies, if the roof has been inspected and is in good condition, especially tile, they'll take 15 or 20.
Oh,
Yeah.
Okay. Then questions about the market correcting itself. Laura has approved a 45% increase, right? For insurance companies, rate increase.
No, well,
Commissioner Laura.
it's very well. Each company's different, right? So there has been, like Wawanesa got a 40% rate increase approved. Others have gone that traditional route of 6.9, and then again and again and again. State Farm has a 40% outstanding. I don't think that's been approved yet. Allstate's 40, I think, did get approved. There's a lot that's out there right now that are starting to move their way through the system.
And are they going to change the reinsurance requirement I'm looking, is the market going to correct itself?
Yeah, well, that is part of what he'll describe as the modernization of the code. So he is asking for that, and that's where you guys play a very important role to say to your local representatives, let's get this code fixed. Because right now, insurance companies have been very loud and clear that the way it's currently working is unsustainable. So reinsurance right now, Laura doesn't have the power to do that. That's not something the commissioner can do. It has to be a legislative change.
That's why we were saying you really have to write.
Yeah, it's very important.
This is about a writing campaign more than anything, at least just letting them know that there's a problem, you realize there's a problem, and you want your representatives to actually write some bills and get them passed to fix that.
Then,
Oh, sorry,
one last question is, why are carriers pulling out of commercial HOA policies so aggressively?
Really poor loss experience. That's really it. That's why you're seeing some of this stuff. It's Florida's going through it too. There is so much deferred maintenance with these HOAs that it's gotten, again, unsustainable, where the carriers are just getting hit with really large losses, and they've just said, forget it. We just don't want any part of it. So the condo insurance market in California right now is as difficult and as bad as I've ever seen it. Almost every carrier doesn't want condo. And the reason why that's happening is most condo associations, in order to keep the peace, they have what are called anti-subrogation provisions. So you're in your condo and the guy upstairs causes water loss in your condo, you can't sue him. You just pay it and you're done. You can't, what's called subrogate, or have your company pay yours and they go after them. That's great, you guys aren't fighting with each other, but insurance companies have said, I don't even know what I'm underwriting anymore because I thought I had your condo, but now I got to worry about this one, that one, that one, and that one, and I don't have any information on it. I'd rather not do it. And so we've got like 2 companies that are writing condos right now. And landlord condos are basically non-existent. It's very, very challenging.
So what I'm seeing on the property management side and when I'm on the buyer side of the transaction, every time that I can think of several properties right top of mind that I've either turned down managing a condo because I remember how bad the home inspection was and the lack of barrier walls up in the attic space separating the units, or just some of the deferred maintenance that we knew was an issue, and we talk about this, and this would be what the client could afford, and so I'd be saying to them, but you're going to have to make sure that some of these things get done. And then they do or they don't. And so here you are 5 years later, 10 years later, and now there's some of that's coming to roost.
Anybody ever watch Friends? Do you remember when Ross refused to chip in for the building manager because he had just moved in? That's deferred maintenance. Everybody who moves in is like, it's not my problem. I just got here. I don't want it. And then they become 5 years and 10 years in, and it's not getting done. And that's the challenge.
Yeah. But I think, but he and I are both seeing it on different sides of that equation.
Yeah.
They'll call me first to manage, or they'll call me first and say, oh, we want to buy this place, or we want to sell this place, and I'll take a look at it, or it's a condo complex I already know, and then I'm like, oh yeah, that one. Okay, well, let me tell you what I know, and then we go from there. So yeah, that's just a piece of that. So, okay, other questions?
A couple questions in different areas. So first one is the legislators that are preventing the insurers from doing what they need to kind of compete. What's their motive to not allow that?
So
can we repeat that? So what he was asking, in case you couldn't hear, I know it's hard for John to probably hear, is what is preventing the legislature from passing these bills and moving things forward so we do have more choices?
Politics. So there's sound bites, right? So if you'll listen to the author of Prop 103, they'll say, "Oh my God, insurance companies are making a killing. This is unfair. I've kept rates down. You don't need any of this." Insurance companies, by the way, who actually everything's public. These are publicly traded companies. The data is the data. They're saying we need the change, but now you got this big political fight, right? So you got both sides. One side saying you're wrong, you're liars, you're cheating, and the other side saying we're losing money, we don't want to be here anymore. I have never seen a market where its largest companies have said I refuse to do business here. That's just unheard of. So something's got to give, right? I think if it's one company, you can go, that company's they're scumbags. That's not what's happening. It's every company saying I can't make it here. So hopefully the logjam breaks. But it's politics.
Second question is, earlier you mentioned that the FAIR plan is underfunded, but they would still be able to pay out because they would reach into...
They have the ultimate power. They can assess every admitted company in the state.
So how? Why do they have that power to do that?
Because every carrier that gets licensed to do business in the state agrees that they will abide by the assessments that the FAIR plan gives them. Can't do business in the state of California unless you agree to do that.
Except you said they're non-admitted companies.
That's right. So the admitted carriers have to participate in FAIR plan. They're also protected by the state's insolvency fund. Now, interestingly, ethically, I'm not allowed to say to you, well, the insolvency fund's there to protect you, because the reality is we don't know how good the insolvency fund is. It can be 10 cents on the dollar. I have no idea. Not admitted carriers don't have to contribute to the FAIR plan, and they're not protected by the insolvency fund. So they come in and say, I'm not burdened by all that, so I can compete, I can still be competitive with my rates, and I don't have to deal with all this other bureaucratic stuff that's going on. So,
Well, they may not be able to pay.
yeah, I mean, I could send you an article that says that more admitted carriers fail than non-admitted carriers are very good companies. They're all licensed, U.S. based. They carry what's called an excess and surplus lines of license. They still get audited. They have to have surplus. They can't just come in and go, I do whatever I want. They are regulated. They just are more freedom than an admitted company. They're very good. We work with a lot of non-admitted. We won't recommend anyone who's not A- or better.
Oh, so you do work with them, and
Absolutely, we sell a lot of non-admitted business. Where else are we going to go?
and you can find fire insurance for
Yeah, I mean, some areas no, you're on the FAIR plan. You just are. But there's a lot of areas where we're able to find a really good non-admitted company. And frankly, we're finding right now the non-admitteds are definitely a little more aggressive. We're in high fire risk areas, not a lot aggressive, but where they're more accommodating is on older homes. So if your home was built in the 90s and 80s, you're going to have a really hard time trying to get a new insurance policy unless that home's been completely updated. So the non-admitted carriers are being a lot more forgiving, the carriers that are fleeing right now that don't want to be here are throwing up every barrier imaginable to try to keep that continues. Yeah, I mean, look, if they can't fix the existing regulations, I think all property is going to end up going non-admitted in the next 5 to 10 years. Because I think carriers would just say, look, I'm tired of it. I can't operate within this box, so I'll just remove the box and we'll do that. I don't want that to happen on auto because that would really create a problem. But for property, it's a little easier to manage in that business model. But yeah, I would not be surprised if we see not admitted become a dominant force in the next decade.
Yeah. Kind of a tangent, but I grew up in California. When I was young, we did not discuss wildfires because we did not have them. What has changed?
So if you talk to a lot of firemen, they'll tell you it's forestry management. That the density of what's out there is incredible, and we hold ourselves back as a state and say, "No, you're not allowed to go in there because of this, and this." So it's some of it's forest management, some of it is we've built a lot. You know, so we're in a lot of areas now that historically we haven't had homes and towns and whatnot. Yeah.
So what I've heard with forestry is they used to allow the logging companies to go in there and log the trees. And in the process of logging the trees, they'd clear the ground and they'd manage the forest because burnt lumber isn't any good to them. So they would manage it. And then the environmentalists came in and said, oh no, you can't touch this sacred ground for whatever reason. And so now nature takes over, pine needles all over the place, everything else, little saplings, trees too close together, all that happens. So when there's a wildfire, and now it's out of control. And so there you go. There's another letter for you to write.
It's probably getting far afield of it.
Well, San Diego County has a lot of federal and state managed land, and so some of that's well managed, some of it's not. And it is amazing to see how many places that are basically in cities are still having trouble getting carriers. I'm thinking of one condo that I had called Kyle about that's right on El Camino Real in La Costa, but it's across. It's south of La Costa Avenue, off of El Camino Real, just on the east side of El Camino Real. It was built it's newer. It was built in the 90s, so it wasn't.
Yeah, it's right on the edge.
It's right on the edge.
I'm sorry, of the condo age
the
too,
condo
where it's
age
hard.
too.
Yeah.
But it's because that whole hill right in front of it, on the other side of El Camino Real, the west side of it, is all brush. So there's nothing that HOA can do. They were dropped, and I was calling Kyle and saying, can you help them? Like, they're really not.
Yeah, condos are super tough.
And there's nothing. This was a townhome. There was nothing they did wrong. The house is super clean and everything inside of it's updated, etc., etc. So there's some pieces of this that are land management that we when it is, that's certainly in a dense area. There's people just east of it. Most of the fires tend to come east towards the west, not west to east, but that's why they were dropped. So that's another interesting piece of that. So again,
yeah, more fires burn in Texas every year than California, but 95% of the land is privately owned in Texas, so people maintain the land typically. So. And I think 10% of the fires we had last year were man-made, which is pretty weird. So we have
the
a lot of
copycat
arson.
fires.
So 2 million to 20 million acres that were burned last year were arson.
Wow.
That's pretty crazy. But,
Go ahead.
It might be of interest. I don't know if any of you were around here and remember the Harmony Grove fire,
Yep.
which was in October 21st of 1996, a day I remember very well. It was a typical Santa Ana. The fire blew to the west, and the epicenter of that was my neighborhood, where everyone that didn't have a new roof lost their home, including me. So we rebuilt on the site a much more fireproof house with a high roof and all that. Since then, the whole community of San Leo Hills has been built in the area that burned, and there's a brand new beautiful fire station very close to where I live. Now there's still a canyon down there, but for whatever reason, 25 years later, now my insurance company that I was with forever said they're not renewing. So maybe I was lucky. I got the auto club to cover it. They're apparently covering some. I don't know. You know.
The one policy, right? The
Yeah.
one policy a month, you got it.
Yeah.
Really? Well,
And San Leo is tough because it is surrounded there.
well, I'm not in San Leo, and I'm in La Costa actually. But I'm saying it's not the fire hazard that it was
Yep.
back in those days.
Yeah, like I said, it's so much more than that right now. So the
Yeah.
fire hazard is a convenient excuse for carriers, but it's all the other stuff
It
that's
could be
going
the
on.
smoke damage because there's another area that is a higher fire hazard.
But anyway, I noticed, I guess I'm very lucky that I got policy. I mean, this happened last year. And now I got my renewal from the auto club. And it's a little over $6,000 a year. And I guess maybe
I would tell you to keep
that's
that policy.
good.
Yeah.
I would tell you to keep that. I mean, we have a
Yeah.
number of clients that will call us
Right.
and they're surprised that we're honest. I'm like, look,
Right.
love your business, but you
Sure.
should keep that policy because once you give it up, you're going to be,
Yeah.
you're going to be moving every year thereafter.
But
So hang on to
how
it.
did they get to charge so much? They got approval for
So this is a complex answer.
Yeah.
So what I will tell you is that the way pricing works is there's an overall rate increase on your book that they manage to, but they look at each individual risk separately. So some people might see their rates triple, and a few people might see their rates go down, and on average, it gets to whatever that overall is. So when Allstate takes a 40% rate increase, some people are going to see 300%, and others might take 4% or 5%.
oh, so it's just
So-
an average.
Yeah, that rate increase you hear of is always the average. It's not what each individual risk is going to see a different rate impact depending on location, claim history, and all those things that go into it.
But at least if we have more carriers, then at least there's some more choice. If we have nothing but the fair plan, then it's on every citizen in the state. I mean, because at the end of the day, we're all then still responsible. So that would be a really hard place to be, right? Great questions.
So Allstate is going to raise the rates 45%?
Yeah, what was it? I think the number was 40,
Oh, it's
right?
36%. They said some people will get as much as 600%.
Yeah.
In
Yeah,
some
it's going to
areas.
be a
Not
very
many
wide
people see
range,
Northern
but the
California.
overall is in that 30
It'll be
to
mostly
40.
Northern California, I think, that takes that hit.
Yeah,
With the 600%.
our area, San Diego County, has got two major issues in terms of why rates are rising. One is obviously wildfire, and the other is this area has been just really hit hard by water losses from pipes. All those homes built in the 70s and 80s, leaky pipes, and those are big claims, and usually end up being $100,000 because the pipe bursts. They're not home. You come home, all the floors are warped. Everything. I mean, it gets
And we've had
expensive
more rain
quickly.
in the last couple of years.
Yeah.
Cast iron pipes and hard water.
We are laughing because cast iron pipes and hard water on old apartment buildings. Yeah,
I get a lot of those
it's a
calls.
thing. We've definitely been there.
Yeah, the Wall
done
Street
that.
Journal actually had a really good article on that. It was like 3 or 4 years ago. It's not just here either; it's across the country.
Yeah,
So the water losses are a big deal.
cast iron was really stopped being what was put into a property pretty much after 1972. And most properties don't have it after 72. So, and it was only meant to last 50 years. So
We're there.
We're there. I mean, and if it has good drainage, good slope, then when we do sewer cams, we see that everything looks okay and it's clear. But if the line is not sloped properly, if there's a dip in it, any of that, we start seeing that, oh, it's cracked, it's broken, wherever it is. It could be under the ground, it could be, 3 feet under the slab. and then we're calling companies to line it and do other tactics, right, to get around it. So, yeah.
What percentage of claims are water claims? Pipes breaking.
I mean, that's probably the number one claim. Wildfire is probably number 2 or 3. But water claims are the most common claims among property insurers.
And what percentage of that is like flooding?
So flood, the way to think about flood is, so there's a true FEMA declared disaster flood. That's maybe 25 to 30% of all flood claims. The rest of flood claims
Across the country?
Yeah.
Okay.
The rest of them are from surface water. Heavy rains, surface water builds up, it seeps in. And so we tell folks, if you're in an area where you're in a flat area, you're not in a flood zone and you're in a flat area, don't worry about it. But especially here, when you're in an area where you're at the bottom of the hill, even if you're not in a flood area, we think flood makes a lot of sense because water comes over, whenever we have heavy rains, water comes down the hill and it's going to come into your foundation. So flood is all surface water. Your regular home policy won't cover surface water. It will cover water from burst pipes and water intrusion on your roof, but it's not going to cover surface water.
I don't want to be asking too many questions, but you got a lot of information. Can you talk a little more about the reinsurance market? Because I remember maybe way back when AIG was about the only reinsurer, and then they had to be bailed out, in the financial crisis.
The reinsurance market is really healthy and it's big. I mean, all kinds of companies you've heard of and not heard of that are in there. Generally speaking, with carriers, like if you look at a State Farm or an Allstate, when they go out to the market for reinsurance, it's a panel. They'll work with 5 or 10 reinsurance companies that will take on a bucket of risk. And then those reinsurers will look and say, okay, great, so I'm going to charge you based on where your risk profiles are. So lots of modeling happens. And you look at where all your exposures are in California, and Texas, and Arizona, and Florida. And depending on what your risk profile is how much you're going to pay for reinsurance. So carriers are always looking for offsets. So, like all states all over the country, so their reinsurance costs are going to be high because they have a lot of risk in a lot of the areas that traditionally get hit with hurricanes and hail and fire.
Like you said, it went up to being 20% from just being.
It's a lot more expensive now because reinsurance claims have been extraordinary. I mean, if you look at, like I said, just convective storms in the Midwest, that wasn't a thing 10 years ago. And now you're starting to see, pretty substantial reinsurance claims being paid on it. So Florida's had a number of hurricanes. So that affects all of us. So when Florida gets hammered, it affects all of us because the cost of reinsurance works its way through. It's like the cost of oil. Oil goes up, gas goes up, plastics go up, pharmaceuticals go up. I mean, we're going to feel that, when other states get hit with catastrophes.
Great question. Any other questions?
I have one last
Go
one.
ahead.
So, if the legislators start approving these the allowance for insurance companies to raise the rates, is that kind of like is that going to bring in the removal of fair plan?
So, in theory, if we can create a healthy market for competition, you bring more carriers back in, and rates start to come down because everyone's starting to compete again. The fair plan will always be there. We need it. You do need an insurer of last resort because there are a lot of old homes that are just uninsurable. The fair plan actually was started after the riots in the 60s because there was homes that were just uninsurable in certain areas. That's really what it was meant for. It was never meant to be this fire mechanism that it's turned out to be. But we need it. It'll always be there. Every state has their version of an insurer of last resort. But what we need right now is a healthy, competitive market, and we don't have anything close to that. We just have most carriers not wanting to be here.
So, to kind of tag along with Ethan's question, what percentage do you think in the county, what percentage of homes are on the fair plan right now?
Yeah, they're lagging in their data, but probably 6 or 7%, whereas maybe basis points, a decade ago. So
and it was meant to be like 1% or less.
Yeah, so it's always meant to be very small. Yeah, they're so far bigger than they ever had anticipated that they would or should be. we don't want that. We want to depopulate that. The equivalent of that is Citizens in Florida. That's their insurer of last resort, and Citizens is the largest insurance company for property in Florida. That's a problem. So they've been working on depopulating that over the last few years, and it's been tough going. Yeah.
Is there an insurer of last resort for insurance other than fire in California, like liability insurance or anything like that?
No.
So
The
it's
only thing we
strictly
have
fire.
is the fair plan for fire.
So in other words, you can get insurance on everything else, but you still have to have fire with it. He can't write separate policies. It sounds like no insurance broker can, so.
No one who wants to keep their license.
Yeah, exactly.
So.
All right, one last shot. Any other questions? Go for it.
So it's, what I'm getting from this is that I'm gonna need to look for a non-enrolled, is it called? Non-enrolled.
Not admitted?
Non-admitted.
It's not admitted, yeah.
Non-admitted. And do most independent brokers deal with
Some
non-admitted?
have access to more than others. So
yeah.
your captives may or may not. So they'll have less than like we're an independent.
Right.
So we probably have more
Yeah.
non-admitted options than your typical captive and a lot of other independent.
What does that mean, captain?
So the captive is a State Farm agent or an Allstate who only sells that product and nothing else. An independent is what we are. We represent lots of companies.
And what are the names of some of these non-admitted?
There's lots of them. So like we work with Johnson & Johnson, which is the marketing arm for what is that?
Great Lakes.
Great Lakes SC. Great Lakes is an A+ carrier. They're awesome, and that's a non-admitted company. We work with SageSure, who's a broker who have a number of non-admitted options within their ecosystem. Bamboo is a marketing arm. They have both admitted and non-admitted options. We have a company called Coastal that does non-admitted. Who am I missing on the non-admitted? Heritage is another one. Really good company. They have a non-admitted home product. So the non-admitted that we work with, we like a lot. They're well capitalized and they do a nice job.
Great, thank you.
All right, thank you so much.
Yeah,
Really
thanks.
appreciate it. And of course, they'll be able to answer any questions later and the next day.
Yeah, absolutely.
Thank
Kyle's
you
got
so
his
much.
cards. You want to hand out your cards? If you have any
Yeah,
questions,
you
just
can
call
put it in your
us. and-
folders and have the info.
Just gonna run to the bathroom real quick.
Thank you for coming.